Welcome back, traders. We are all focused on the geopolitical front as the new US administration is working towards peace deals in Gaza and Ukraine while German elections are taking stage this Sunday. But it's not all about politics this week. The first half of the week will be dominated by central bank meetings. The Reserve Bank of Australia is deciding interest rates on Tuesday. And the same day, the UK will release its employment report, while on Wednesday, UK CPI inflation figures and the FOMC meeting minutes may cause further volatility in FX markets. So this video will break down three major FX pairs: Aussie dollar, pound dollar, and dollar yen. And let's have a look at what the technical signal suggests. Then starting first with Aussie dollar, well, the Reserve Bank of Australia is expected to cut interest rates by 25 basis points. This will be the first rate cut in Australia. And questions remain about whether the central bank will continue to cut interest rates in the coming months as inflation is around its midpoint target. And GDP growth seems to be decelerating. In the fourth quarter, there was another growth slowdown in the economy. So it will be quite interesting to see whether the central bank will signal more rate reductions. If monetary guidance appears dovish, then we could see Aussie dollar reversing some gains. The 0.6288 and 0.63 territory where the 20 and 50-day moving averages are located and where these lines have posted a bullish cross could be important to watch as an immediate support area. A break below this territory could take us down to 0.6230, where the price pivoted last week, but failure to hold here could cause a more aggressive decline, probably towards the 0.61 and 0.6086 territory, where this downtrend bottom out near a 5-year low. Then further losses from here could target the 0.60 and 0.5983 region, where this longer-term trend line coming from 2023 is placed. Now, in the event the Reserve Bank of Australia adopts a more data-dependent approach, as the Fed did, and suggests that there's no urgency for further rate reductions, then we could see this recovery phase extending towards the 38.2% Fibonacci retracement of this downfall at 0.64. The 0.6445 could be another critical territory to watch, as this constraining line from 2023 is located. So I would like to see a clear close above this region before targeting the 0.65 round level, where the 50% Fibonacci mark is located, and the 200-day moving average. Well, looking at the technical signals, both the RSI and the MACD are fluctuating in the positive region, so the short-term bias is looking positive, but some caution is required as the stochastic oscillator has already entered the overbought zone. And now turning to pound dollar, well, UK employment data are expected to show a resurgence in wage growth. So that could create some concerns about inflation, and inflation has already started to edge higher in the UK. So higher than expected wage numbers could further dampen hopes for additional rate cuts, and that could help pound dollar to surpass the 1.26 number, which is currently acting as a resistance. This is also where the 38.2% Fibonacci retracement of this downtrend is located. So I would like to see a close above this area before targeting the next resistance seen between 1.2765 and 1.28, where the 200-day moving average is placed. Then on Wednesday, we have UK CPI inflation data. The core and the headline CPI data are both expected to head higher, so that could be further evidence that there is no urgency for additional rate cuts. Currently, futures markets are pricing in 50 basis points of monetary easing or otherwise 2 rate cuts, but if wage growth and inflation surge to the upside, we may see rate expectations falling to 1 rate cut. So So if that happens, pound dollar may abandon its rally and could reverse to test. It could reverse lower to test the 1.24 and 1.2455 territory where the short-term support trend line is located. Failure to hold here could take us down to 1.2350. If there is no consolidation here, if the price surpasses this area, then the decline could stretch towards the 1.2235 or 1.2270 region where the upper band of this broken bearish channel is placed. As we can see from the technical signals down here, the risk is also skewed to the upside in this market. The RSI is comfortably above 50. The MACD has also entered the positive area after a couple of months, but the stochastic oscillator is already in the overbought zone, so that makes us think whether additional upside movements may come at a slower, may come softer. And finally, looking at dollar yen and the FOMC meeting minutes, well, I don't expect any fireworks coming from the meeting minutes. The Fed was clear. It's still on hold and is monitoring inflation data, so it's data dependent, and its decision will depend on whether there are significant changes in inflation data and in growth data. But so far we don't have any significant changes, so the central bank is on the sidelines. So I don't expect any fresh updates to create volatility on Wednesday unless policymakers convince traders that 2 rate cuts might be likely in 2025. Futures markets are currently pricing in only just a single 25 basis point rate cut. If the FOMC meeting minutes appear dovish, then we could see this decline extending probably below this bearish channel and beneath the 150.85 region. So failure to rebound here could take us down to 149.50 territory, where the 50% Fibonacci retracement of this upleg is located. Then below that territory, there is no important support levels until the 148 number, where the 61.8% Fibonacci mark is seeking. Now we also have a couple of Fed speakers on the wires later this week, and geopolitics may also cause some volatility in safe havens assets, including the US dollar. Don't forget that there are also rate hike expectations in Japan. Better than expected GDP data out of Japan helped the Japanese currency to gain some ground today. So Bank of Japan headlines and both the US and Japanese factors could affect dollar yen. So in case the US dollar manages to rebound near 151.50 and perhaps surpass the 200-day moving average of 152.17, then the 20 and 50-day exponential moving averages could block their way up. The lines are currently between 153.50 and 154.30. The 23.6% Fibonacci mark is adding extra importance to these regions, so a successful penetration higher may stage a fast rally towards the 156.30 territory, where the price paused a couple of times from November onwards. Then above that, there might be another test near this broken support trend line, seen currently near 157.40. Well, if we look at the RSI, the stochastic indicators down here, it seems that buying appetite is weak. Both the RSI and the stochastics are sloping downwards, so that means a bearish bias for the market. So downside movements are more likely than upside ones. So that's everything I wanted to share with you guys. Thank you for watching, and our next technical update will be on Thursday. Thank you for watching, and see you next time. Bye bye for now.